Ladies and gentlemen, thank you for joining us here today at the outcome of the Monetary Policy Committee deliberations. Since the previous meeting of the Monetary Policy Committee, the risks posed to the global and domestic economy from the crisis in Europe have intensified, as I'm sure you are all aware. The mounting speculation about a possible Greek exit from the Eurozone has shaken the financial markets as the dangers of contagion effects translating into a global crisis escalate. These developments have the potential to further undermine the fragile recovery in the advanced economies and reinforce the current slowdown seen in some of the major emerging market economies. The global uncertainties impart a downside risk to the domestic economic growth outlook, which remains relatively subdued. The turbulence in the financial markets has caused the rand to depreciate, but the associated risk to the inflation outlook is offset to some extent by the lower international oil prices and depends on how sustained the depreciation will be. Inflation is nevertheless expected to remain within the target range over the medium term. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, was 6.1% in April, up from 6% in March. The increase relative to March was mainly due to the 71 cents per litre increase in the petrol price in April, which includes the higher levies that were announced in the budget. The categories of food, housing and utilities and transport together accounted for 4.2 percentage points of the inflation outcome. Core inflation, as measured by the exclusion of food, petrol and electricity from CPI, increased from 4.4% in March to 4.5% in April. Food price inflation reversed the downward trend observed since December 2011 and increased from 8.9% in March to 9.1% in April. This was in line with expectations, and a resumption in the downward trend is expected in May. Year-on-year producer price inflation moderated further, measuring 8.3% and 7.2% in February and March 2012 respectively. Food inflation continued to decline, particularly at the agricultural level. Agricultural price inflation, which reached a recent peak of 12.9% in October 2011, declined from 4.6% in February 2012 to 4.1% in March. Manufactured food price inflation declined from 10.9% to 9.6% over the same period. The inflation forecast of the bank is lower over the near term than at the time of the previous meeting of the MPC. Inflation is seen to have peaked in the first quarter of 2012 at 6.1%, compared with the previous forecast when a peak of 6.5% in the second quarter was anticipated. Inflation is expected to average 6% in the second quarter of 2012 and thereafter to follow a gradually declining trend within the target range. The forecast period has been extended to the end of 2014, and inflation is expected to average 6% in 2012, 5.5% in 2013, 5% in 2014, and 4.7% in the final quarter of that year. The improved near-term forecast is due to lower than expected recent inflation outcomes, which lowered the starting point of the new forecast. The forecast for core inflation continues to show a moderate upward trend in the short to medium term. This measure is expected to peak at an average of 5.5% in the second quarter of 2013, marginally higher than in the previous forecast, before moderating and averaging 4.5% in the final quarter of 2014. The survey of financial analysts conducted by Reuters in April also indicated an expectation of lower inflation compared with the March survey. Analysts expect inflation to return to within the CPI target range in the final quarter of 2012 and to average 5.5% in the subsequent 2 years. Global economic prospects continue to cloud the domestic outlook. The stabilizing impact of earlier ECB interventions, particularly the long-term refinancing operations known as LTRO, appears to be losing momentum, and their positive impact on spreads on some peripheral European country debt proved to be short-lived. These spreads have risen to levels similar to those prevailing before the first LTRO in November, and uncertainties posed by and the ramifications of a possible Greek exit from the Eurozone have resulted in heightened risk aversion in financial markets. Volatility is likely to persist unless decisive political decisions are taken, but the fluid political dynamics in the region have increased the unpredictability of policy responses. Growth in the Eurozone remains weak, with a technical recession being avoided because of a stronger than expected outcome in Germany. However, almost half of the EU countries are experiencing recessions against the backdrop of continued bank deleveraging, banking stress in some countries, fiscal consolidation, and high and rising unemployment. The current turmoil in Europe poses a danger to global prospects generally, along with high oil prices. The UK economy is in recession, and growth in the US and Japan has also moderated. Although the growth in the US is expected to remain positive for the rest of this year, the risks to the outlook come mainly from a possible sharp fiscal adjustment at the beginning of next year. Growth in emerging markets remain positive, but some loss of momentum has been observed. The Chinese PMI declined further in May, and downside risks to growth are likely in emerging markets in the event of an unfavorable and disorderly Eurozone outcome. Growth in sub-Saharan Africa continues to be robust, but could be negatively affected by weaker commodity prices. World inflation remains relatively contained, despite high international oil prices. Movements in the rand exchange rate continue to be dominated by changing investor sentiment in international financial markets. Since the previous MPC meeting, rand volatility increased and it appreciated to a level of 7.65 of 7.65 against the US dollar before resuming a depreciating trend. The exchange rate was given some impetus by the announcement in April of the possible inclusion of the rand in the Citibank World Global Bond Index. However, renewed concerns about the Eurozone outlook caused the rand to depreciate further, in tandem with a weakening euro, reaching a level of around 8.40 Rand against the US dollar. This was despite net purchases of bonds and equities by non-residents over that same period. Since the previous meeting of the MPC, non-residents have been net purchasers of bonds and equities to the value of 16.4 billion rand. Over the same period, the rand has depreciated by 9% against the US dollar, by 3% against the euro, and by 6.2% on a trade-weighted basis. The extent to which the rand depreciation feeds into the inflation outlook depends on the extent and duration of the moves. This, in turn, is likely to be highly dependent on the timing and nature of the developments in the Eurozone, and therefore a protracted period of exchange rate volatility is possible. In the absence of a speedy resolution to the crisis, the rand is likely to remain at current levels or even weaken further in the event of a disorderly unravelling of the Eurozone crisis. Under such circumstances, the unfavourable impact on inflation could be ameliorated to some extent by offsetting movements in international oil prices. However, the exchange rate has re-emerged as an upside risk to the inflation outlook. The deteriorating global outlook poses a downside risk to domestic growth. The bank's central forecast for GDP growth is more or less unchanged since the previous meeting of the MPC at 2.9% for 2012 and 3.9% for 2013. Growth is expected to average 4.1% in 2014. The output gap, around 3.5%, is only expected to begin to contract during the course of 2013. However, the possible contagion effects from a further slowdown in Europe will impact on domestic growth through the trade channel, imparting a downside risk to this forecast. The bank's composite leading business cycle indicator has been increasing slowly, consistent with the uncertain economic environment. Recent developments underscore the continued fragile and uneven nature of the recovery. Mining output contracted at a seasonally adjusted rate of 5.5% in the first quarter of this year, compared with the previous quarter, a result of strike action, safety-related stoppages, and temporary closures for maintenance. Commodity prices are expected to remain under pressure due to global uncertainties. The performance of the manufacturing sector has been more positive, with the physical volume of manufacturing production having increased at a seasonally adjusted rate of 1.9% in the first quarter of 2012, compared with the final quarter of 2011, and is therefore expected to make a strong contribution to first quarter GDP growth. However, manufacturing production contracted on both a year-on-year basis, minus 2.7%, and a month-on-month basis, minus 4.3% in March. The Kagiso PMI reflects the slowing momentum in the sector. Having increased markedly in February to 57.9, it declined in the subsequent 2 months, but at 53.7 in April still indicates positive growth in the sector. The utilization of production capacity in manufacturing increased marginally to 80.5% in the first quarter of 2012 from 80.1% in the previous quarter. The construction sector reflects the hesitant recovery in the economy. While the sectoral growth performance appears to have improved, particularly with respect to civil construction in the first quarter of 2012, the real value of building plans passed declined for the third successive month in March, reversing the recent positive trend. The 3-month-on-3-month decline was 10.2%, while the year-on-year decline was 24.2%. Consumption expenditure by households, which was the main driver of growth in 2011, has shown some signs of moderation. Real retail sales contracted at a quarter-to-quarter rate of 1.2% in the first quarter of 2012, although the year-on-year increase was 6.8%. Nevertheless, household consumption expenditure is still expected to contribute positively to real gross domestic expenditure in the first quarter, albeit at a slower rate than the annualized 4.6% measured in the final quarter of 2011. New vehicle sales growth remains positive, although the short-term momentum has slowed noticeably in recent months. Motor vehicle exports are also being adversely affected by the weakness in the Eurozone economy. The outlook for consumption expenditure will be determined in part by employment and wage settlement trends, as well as by credit extension. These developments are likely to underpin expenditure at sustainable levels. According to the quarterly Labour Force Survey of Statistics South Africa, the number of people employed increased by 400,000 from the first quarter of 2011 to the first quarter of 2012, despite the unemployment rate increasing from 25% to 25.2% over the same period. According to Andrew Levy Employment Publications, the overall average wage settlement rate in collective bargaining agreements was 7.3% in the first quarter of 2012. The outlook for wage growth is likely to be impacted to a significant degree by the outcome of the public sector wage negotiations. Credit extension to the private sector has accelerated recently, despite subdued mortgage lending. 12-month growth in total loans and advances by banks to the private sector measured 9.2% in March 2012, the highest growth rate since February 2009. This was mainly underpinned by growth in the category of other loans and advances, which was driven initially by household sector demand. However, in the first 3 months of 2012, corporate sector demand has been more significant, possibly reflecting improved business activity. 12-month growth in total loans and advances to households measured 6.8% in March. This includes the growth in the largely unsecured general loans to households. Growth in this category moderated to a still high 29.4% from a peak of 39.3% in June 2011. However, notwithstanding the need to monitor carefully developments with respect to unsecured lending, there are no signs of stress in the banking sector. Impaired advances as a percentage of gross loans and advances have declined steadily from 5.8% in March 2011 to 4.6% in March 2012. International crude oil prices have moderated in recent weeks in line with the deteriorating global outlook and a significant increase in Saudi Arabian production. Having traded at around $125 per barrel since mid-February, the price of Brent crude oil declined in mid-April to below $110 per barrel. The domestic petrol price increased by a cumulative 99 cents per litre in April and May. However, a sizable reduction is expected in June, despite partially offsetting exchange rate movements. Food prices have continued their moderating trend, which is expected to continue in the short term, notwithstanding the reversal in April that was due to base effects. Domestic maize prices are substantially lower than those prevailing at the beginning of the year and have reverted to trading close to export parity levels. However, global food prices have increased in the first quarter of this year, and although they remain well below the levels reached in 2011, may indicate further food price pressures in the medium term. Administered price increases remain on average in excess of the upper end of the target range and are the main factor keeping an upside pressure on inflation. Administered price inflation measured 11.6% in April and 8.9% when excluding petrol. The main drivers include the 17.3% increase in electricity prices and the 9% increase in education costs. Communication costs, by contrast, continue to decline. The greater uncertainty in Europe and associated global financial market turbulence has impacted on the perceived risks to the outlook for both domestic inflation and growth. The Monetary Policy Committee is of the view that these developments pose a downside risk to the hesitant domestic growth prospects. The balance of risks to the inflation outlook is less clear. While the inflation forecast appears to be more favorable, there are renewed upside risks from a possible further weakening of the exchange rate. However, countervailing pressures could come from weaker demand and lower commodity prices, particularly those of oil. On balance, the committee judges these risks to the inflation outlook to be somewhat on the upside. In this highly volatile and uncertain environment, the MPC is of the view that it is appropriate to maintain the current accommodative monetary policy stance, given the continued absence of clear signs of excess demand pressures. The MPC has therefore decided to keep the repo rate unchanged at 5.5% per annum. However, the committee will continue to monitor events closely and assess the risks to the outlook on an ongoing basis, and stands ready to act in either direction, should it be deemed appropriate. Thank you. I'm happy to take any questions and comments for me and my colleagues. If I can ask you just to indicate, this is quite bright lights, so if I can ask you to indicate quite clearly so that I can see you and identify yourself as well, if I could. Miriam?
Thank you, Miriam Issa from Business Day. Was there any discussion of a rate cut, and could it be considered at some point in the future if the global turbulence gets worse?
I would refer you to the statement that we've just said. In terms of this meeting, no. In terms of this meeting, it was unanimous that we hold rates where they are. In terms of the future, we were concerned both to the risks to inflation on the upside, as well as what is occurring in Europe and the, in our view, very serious situation that is continuing. And therefore, we have said very clearly that we would be ready to move in either direction, depending on what becomes the dominant factor. But certainly, there's no question that we consider, and as you are aware, we have considered for a long period of time, that Europe is a very serious risk to the global developments, and we will watch it closely. So there was no discussion of a rate decrease or increase for this meeting, but an awareness that we need to monitor that very closely with different assessment of the risk, both upside and downside, depending on whether we're looking at growth or whether we're looking at inflation. Yes?
Tsepo Moai, SABC News. Governor, in the past few weeks, you were quoted as saying that it looks like inflationary pressures are becoming generalized, and it's very clear in the statement that the outlook is slightly favorable. Do you still share that sentiment that perhaps maybe inflationary pressure might be still generalized?
I think that what we've said is that we are watching whether, in fact, inflation becomes more generalized. You can see it when we're looking at administered prices. It does have an upward trend. What we've seen is that the outcome has been better than what we anticipated. And therefore, because of that lower starting point in going forward, it looks as if it is moderating more quickly than we would have thought. And those are the numbers that I've given you today. But we remain concerned. Our point is that we do think that there is upside risk primarily through the exchange rate impact on inflation at this point in time. So it is for us, on general, an upside risk to inflation, not a downside risk. I don't know if anyone would like to comment on any of the specific. Anyone else? Yeah, on the end there. Sorry, you're just in the light, but okay. Please go.
Good day, Governor. It's Kifilo from this UNISA Radio. Is there a need for the bank so far to intervene in the rand exchange rate volatility?
Just to reiterate, our policy position is that we do not intervene in the currency to obtain either a particular rate or a level. If you are aware, everyone in South Africa has been talking about the rand being overvalued and that it's too strong. With what has happened, there's obviously been a depreciation, and as I think you've seen on the front page of some newspapers today, some people celebrating that they've reached the level that they think is appropriate. You know, they've been talking about an 8 Rand 50 to the dollar is an appropriate level for manufacturing. Well, it's there. We do not intervene to weaken or strengthen the currency. As we've said before, that would be a bit foolish given the size of the market. We don't think that we can do that. But we are obviously watching the situation. And as you've seen, I think, in our reserve accumulation, that has not been affected over the last period as well. So we are watching the exchange rate. It is something that some sectors of our economy have been asking for. We have not done anything to get it there. It has happened as a process of what is happening in the global markets and the question of risk aversion. And we do not intervene to set a rate or to try and achieve a rate. Miriam?
Thank you. Was there any discussion of what the fallout for South Africa might be if Greece exits from the Eurozone?
I'm going to ask some of my colleagues to talk to that, because I think that it was a very significant part of our discussion. But I would urge us not just to look at this as a Greek issue. This is much bigger than a Greek issue. At the moment, it is focused on whether Greek exits and whether it's disorderly. But the situation in the Eurozone is much more complex and difficult than simply talking about one country. We're talking about Spain and Italy and recession across many countries. So in that context, perhaps Daniel Lesetja, someone would like to talk a little bit about the implications for South Africa. Our view is that it primarily will probably come through the trade channel, but there are lots of implications. Lesetja?
Thanks, Governor. I think let's start with the fundamentally two main channels that South Africa would be affected from the euro sovereign crisis. The first channel will be through the demand for South African exports. The euro area is a very important destination for South African exports, and as the economy enters into a recession and it consumes less of South African products, it will have an impact on the South African economy. As the Governor said, that will be the trade channel. The second channel is going to be the finance channel, which would have to do with the fact that every time there are these gyrations in Europe, global risk aversion returns. And when there is global risk aversion, people are saying that they are running, they are taking a flight to safety. Actually, it seems to be a flight to familiarity rather than a flight to safety. And emerging markets then begin to experience outflows, as we had also experienced outflows then. But in the recent times, what we had seen had been that in spite of South Africa experiencing net outflows, even when there is this risk aversion, the currency had weakened. The currency had tended to track what actually is happening to the exchange rate between the dollar and the euro. And that just seems to just reflects the importance of the euro area economy to the South African economy.
Yeah, sure.
That as part of the discussions, we also reviewed, as we regularly do, the exposure of the South African banks to these troubled countries in the Eurozone, and those exposures continue to be insignificant, really small in comparison to their total loan books and credit exposures.
Yes?
Is the electricity price hikes less of a concern on the inflation outlook at this point?
Who would like to talk to that? Ryan?
I think that any price increases that are way in excess of the inflation target range are a concern for us. But, of course, from an inflation point of view, we were pleased by the reduction which was already built into our forecast at the last MPC meeting that Eskom requested. But going forward, we're not sure what Eskom will be requesting in the future. We've got a lower price built into our forecast than was previously the case before the Eskom request, but the next round of determinations by NERSA for Eskom, we simply don't know where that is going to go. So that is a risk going forward, but at this point in time, it's a better scenario than was the case 2 meetings ago.
But perhaps just a small point on that, and obviously one's going by what is reported in some of the media, is that talking about electricity price hikes that are way up from what the current are. We just want to reiterate that your electricity provision is a long-term project. These are long-term assets. And therefore the financing arrangements need to be taking into account that you've got 30, 40 years of that asset working for you, and therefore the kind of financing should be looked at over the period of the life of the asset, and not just a question of 3 years or whatever the case may be that some of the reports were indicating. So it should also be taken into account when looking at their pricing. Yes, sir.
Franz Wild from Bloomberg. Governor, some traders are actually pricing in an interest rate cut this year at some point. Are they getting slightly ahead of themselves?
I thought they were pricing in an increase. If you looked at what has been happening so far, it seems to be pricing in an increase, and for people pricing in a cut. My sense was that most the view was to take a longer view and pushing out the time or the date when you would get a rate hike rather than a cut. I think that it's, as we're saying here, it depends on what happens. So if they're pricing in a rate cut, then they might know something more about the contagion effect of Eurozone than we do at this point in time. But what I've said very clearly in the closing statement was that we are very concerned about what is happening there, and we are ready to move in either direction depending on what the outcome is. We think that common sense and policy decisions should prevail in Europe. I'm not quite sure. There was an interview with Danny Blanchflower a few minutes ago, and they asked him how far the clock is along, and he thought, I think they said to him, are you at the 11th hour? And he said that was a year ago. Right now we're at 11th hour plus 57 minutes, so there's about 3 minutes for them to make up their minds on what to do. So it's it is a very difficult situation. So as I've said, we are considering all the factors, and there's an upside risk that we see through the exchange rate to inflation, a downside risk to growth, and the contagion from what is happening in Europe. So we could move in either direction. I can't tell you whether they're getting ahead of themselves or not. Follow-up, Franz, okay.
I'm not sure if it's a follow-up, but there's, in the statement's fairly balanced in terms of the risks to A, inflation, and B, growth. I mean, at this stage, which is of greater concern?
Both.
Equally?
I think so. I'm not going to go beyond balanced. You know, we've got the risk of one and the risk of the other, and they're pulling in different directions. Other questions? While you're thinking, perhaps, I don't know, Rashad, whether you'd like to talk a little bit about growth, because I think you had some discussions around, although our outlook is around 2.9%, I think it just might be useful to give some insight into that.
Thank you, Governor. One of the things we analyzed both in the actual MPC and 2 days before is really trying to understand South Africa's growth trajectory. And as you know, economists use a number of techniques, the output gap, resource utilization. And one of the things we are struck by is we obviously think very hard about the implications of global growth for South African growth prospects. One of the things we're struck by is the fact that at a time when you had one of the most kind of spectacular economic booms after the Great Depression, South Africa's growth rates were around the area of 5%. We're now in one of the most serious contractions after the Great Depression, and we're operating, well, going on the last quarter numbers, which is the fourth quarter, was around 3%. So one of the dilemmas we face is that, you know, we need to grow far greater to catch up with what our potential growth is. But we also kind of acutely aware of the fact that this economy, with the current levels of investment and the current productivity levels, is producing a growth rate that's really far from what it should be if our potential growth is in the order of just above 3%. So this is a very important issue that people must bear in mind, and something we grapple with when we look at the difference between the cyclical movements in growth and the structural constraint to growth, and where monetary policy features in that. And that's one aspect that we spend some time looking at.
Anyone else? Yes, is that on the line?
Governor, a question via the web from Jeremy Curtin. Currently, we have experienced large portfolio inflows, but the rand has depreciated aggressively nonetheless. Could you shed some light on this, please?
Daniel? I'll ask Daniel to do
Yes,
that.
thank you very much. As we've said on many occasions, it's not very easy to put one's finger on the pulse in terms of what exactly influences the exchange rate on a particular day. We have said in our statement that the most recent period has been characterized by an increase in volatility. We have seen, of course, instances where the currency did react to a lot of those inflows, but there are times when you are seeing inflows, but at the same time the currency weakens, so there is not always a very straight sort of relationship. But overall, we have to observe that given the global environment, the rand has probably been somewhat more resilient than it would have otherwise been, given what's going on in the absence of these flows.
I think the essence of it is the automatic assumption that when you have capital inflows, your currency strengthens is being shown not to always be the case. The reasons for it, we would all like to understand better. Any more questions? Anyone else? Yes?
Could you kindly explain the inverse relationship between the oil price and the rand?
The rand.
I think we'll need one of the teachers.
Okay. Monday, can you try to just elaborate what you mean a little bit?
The rand currently, it has depreciated
Yes.
A whole lot more compared to the previous 3 months. And the oil continues to go down. So I want to understand why that.
I think that perhaps just one question, but perhaps also the impact of the counterweight of a depreciation and a falling oil price as well, if you can. Brian?
I think the domestic petrol price is determined by the international oil price and the exchange rate. So what we've seen in recent weeks is the international oil price in dollar terms has been declining, which then effectively should have reduced the domestic petrol price, but at the same time the rand was depreciating, and therefore that increased the rand cost of petrol. So it offset to some extent or to a large extent offset the favourable impact of the declining oil price. What we will see in next month, we expect a reduction in the petrol price, and that's because the international oil price declined far more relative to the depreciation. So the price of Brent crude oil had been around $125 US per barrel a few weeks back. It's now below $110, but the rand has moved in the opposite direction.
That gives the domestic component, but you seem to be talking about the oil price internationally. Is that what you were asking? Yes. You can't just view the oil price in isolation. What has happened was that the oil price was going down when the other key commodity prices were going down, some of which are South Africa's key exports, such as platinum and gold. They had come down since the last MPC meeting. But as the governor pointed out earlier, it would be difficult to pinpoint one indicator and say that this is the exact relationship between that indicator and the currency. There had been so many other things that had happened, and some of those indicators actually played in the opposite direction that people expected them to. We had experienced an increase in capital flows, and everyone, when the currency was strong, said that the problem must have been the fact that we are receiving capital flows. Capital flows had accelerated, and yet the currency has weakened. So the movement of the currency, I think, had to do a lot more with increased global risk aversion in the advent of the euro sovereign crisis.
Are there any other? Sorry, yes, Sean.
Just a little bit also to say that there is evidence to that the supply of oil has generally improved, and that definitely will affect the price going down, coming down somewhat, and that's why the price has been coming down.
Are there any other questions that anyone has? Any additions that anyone would like to make? If not, thank you all very much. Thank you for joining us for this press conference after our meeting, and I'm sure we'll be seeing you with much more information about what has happened over the next few weeks after our next meeting. Thank you all very much indeed.